The Ports, Customs and Free Zone Corporation (PCFC) announced today the establishment of a new company under the name of P&O Ports, which aims to focus on operating medium-sized multi-purpose ports worldwide. The new company is wholly owned by the government of Dubai as a subsidiary of PCFC and will specialize in developing and operating marine and inland ports in markets with a need for well-managed trade and logistics infrastructure. His Excellency Sultan Ahmed bin Slayem, the chairman of PCFC, stated that this strategic initiative supports the vision of His Highness Sheikh Mohammed bin Rashid Al Maktoum, the Vice President and Prime Minister of the UAE and the ruler of Dubai, to achieve leadership in all spheres. His Excellency added that P&O Ports has signed MOUs to enter into preliminary discussions with the governments of Madagascar, the port of Berbera in the Republic of Somaliland and Albania in order to enhance their port infrastructure. The launch of the new company is considered a strategic move based on the thorough future-oriented needs analysis of the global ports industry, with feasibility studies showing that the industry's future growth is not confined to large ports, as the demand for smaller port services is increasing in emerging economies.
You know, we have been discussing this business opportunity with the shipping line, with our customers, with the consignees, the stakeholders in this business. And the reaction is very positive. People would like to see a professional company running the small to medium port. For the shipping industry, this is something that will reduce their costs. This is something that will allow the company to operate efficiently, allow the cargo to move faster in and out. So we are using the experience that we have gathered in the past 40 years in Dubai in dealing with the traditional cargo that used to come.
A Sharia-compliant short-term lending facility has been created by the Central Bank of the UAE to complement a similar conventional facility in case banks face the same kind of cash shortages experienced during the financial crisis. The central bank said in a statement that from April 1st, it would be extending the eligible collateral to include Sharia-compliant securities other than the Islamic certificate of deposits issued by it. According to the statement, Islamic banks operating in the UAE can access funds from the central bank on an overnight basis by posting eligible securities via tri-party collateral management agreement signed with either Clearstream Banking or Euroclear Bank. As part of efforts to strengthen the financial system, the interim margin lending facility was introduced last year to provide funding on an overnight basis for banks that are able to provide eligible securities as collateral. The central bank established the facility after consultations with the UAE Banks Federation, with many UAE banks having received government support in the aftermath of the downturn in 2009, much of which has been paid back. The UAE Credit Bureau will offer company reports for the first time in a move that could eventually help small businesses tap into lending markets more easily. Al Ittihad Credit Bureau, which started to offer individual credit reports last year, will now provide up-to-date information on the 65,000 businesses in the country that have borrowed money. The Bureau said that the commercial credit reports will provide details of company ownership, the credit facilities that are being used, the total amount that they have borrowed, and the company's addresses. According to the Bureau, the new service will allow banks to regulate their risks better when lending. It could also reward companies with good credit scores, especially small and medium-sized businesses or SMEs, with better interest rates when they seek fresh lending from banks. Even though small businesses represent almost 90% of the total number of companies here and provide more than 86% of jobs in the private sector, they account for only about 4% of the total lending. Banks, which have attracted criticism in the UAE for not doing more to support SMEs, say the new commercial service would make it easier for businesses to borrow. The shareholders of Etisalat at their annual general meeting have backed the board's recommendation to pay full year 2014 dividends of 70 fils per share and also approved a 10% bonus share. After the release of the group's 2014 annual results, the board proposed the dividends share, which according to the company is a reflection of the strong results achieved during the fiscal year ending 31st December. Etisalat's net profit increase after federal royalty reached 8.9 billion dirhams. This represents a year-on-year increase of 26%. Furthermore, Etisalat's consolidated EBITDA for 2014 totaled 23.4 billion dirhams, resulting in an EBITDA margin of 48%.